Thanks for joining us today on The Close. I'm Marella Fernandez. Markets close in 30 minutes. Let's get to the stories we're following in the BNN Bloomberg newsroom. The Prime Minister says he's spoken with the U.S. President about the new Gordie Howe International Bridge and explained Canada paid for the construction of it. Ownership is shared between Michigan and Canada. Donald Trump, of course, threatening to block the opening of that bridge until the U.S. is fully compensated. But it's not clear what that means. That crossing expected to open later this year. Air Transat and WestJet suspending all flights to Cuba because of the island's fuel shortage. Cuba says jets can't refuel at its main airport for at least a month. Both carriers say flights will be suspended until the end of April. Air Transat and WestJet are in the process of sending jets there to bring travelers back to Canada. Air Canada suspended flights yesterday. We're watching shares of Paramount, Skydance, and Warner Brothers Discovery. Paramount has sweetened its bid for the media giant and addressed some of the company's concerns. Paramount says it will cover the almost $3 billion termination fee Warner would have to pay to Netflix if it ends a deal with the streaming giant. Warner says it will review and consider that new offer. Shares of Spotify are soaring today. The music streaming giant added a record number of users in the fourth quarter, far surpassing expectations. The Swedish company cited the launch of an enhanced free tier for users as contributing to growth. Operating income and first quarter forecast for monthly active users also beat the estimates. However, revenue from ads did shrink year over year. The TSX Composite well above 33,247. It is in record territory again today, up 223 points or 0.7 of 1%. Let's move south of the border. The S&P not a material move. It's down 10 points today. The Dow Jones is up 102 points or 0.2 of 1%. And the Nasdaq down 86 points or about 0.4 of 1%. Another day, another new threat from the U.S. president, this time about a new bridge that connects Ontario and the state of Michigan, a key trade corridor. Now, it hasn't opened yet, but Donald Trump says it might not if he has it his way. Let's go to Pascal Chan, Vice President of Strategic Policy and Supply Chains for the Chamber of Commerce. He joins us now. Thanks for joining us today.
Thanks for having me, Marilla.
How seriously do you take the latest threat from the American president?
Well, as you said, we have to take the threats seriously. It is another threat from this U.S. administration, and it's tough to know at this point whether it's something that's going to materialize or just remain words on Truth Social. What we do know is it's something that's going to fuel the uncertainty for businesses that we've seen more or less throughout his tenure in 2025. And either way, it is pretty clear that blocking or barricading bridges is just something that would be self-defeating and simply cause damage to both economies.
Okay, so we know he doesn't care sometimes about self-defeating, at least in the near term. Tell me a little bit about the bridge and how much traffic it is expected to have.
Yeah, so first of all, I mean, when you're talking about Windsor and Detroit, there are approximately 2.5 million trucks that cross the Ambassador Bridge annually. And estimates put the volume of goods at up to 25% of the value of all U.S.-Canada roadway trade. Now, this new Gordie Howe International Bridge is expected to handle 400 commercial vehicles per hour. And I think it would go back to 2022, where we saw a blockade on that bridge and estimates reaching that this could have had an economic impact over 6 days that reached 3 to 6 billion, depending on what you're looking at. So, we've talked at length about the need to speed up approvals and deliver infrastructure projects more quickly. This new bridge is something that would help relieve some congestion, enhance fluidity, and simplify some of that trade.
Can you also just expand on what it would mean for the local economies on both sides? And I want to remind people that there are Americans come to Canada to work, Canadians to go to the U.S. to work, and they cross daily.
Yeah, absolutely. Actually, last year, our Business Data Lab conducted an economic analysis of Canadian cities' reliance on trade with the U.S., which allowed us to examine more granular data at the municipal level. And everybody knows that Windsor's economy is very dependent on auto production, given it's home to major assembly plants. So production processes involve plenty of two-way trade with Michigan, which is just across the Ambassador Bridge and soon the Gordie Howe. So for Windsor, trade with the United States accounts for more than 60% of its GDP. Our Business Data Lab also looked across the border, and it's no surprise, I'm sure, to your viewers that Detroit ranked second among American cities most dependent on exports to Canada. Detroit is still the heart of America's automotive industry. It's home to the big three automakers, alongside nearly 100 auto parts suppliers. So Detroit's auto industry is deeply integrated with Canada, specifically Ontario, and together they form one of the most interconnected global automotive supply chains, producing about 22% of North America's vehicles.
Okay. If there was a disruption to the opening, if it was delayed because Donald Trump had decided he didn't want to see it open, what would the fallout be? Obviously, autos, you mentioned, would be a key supply chain that would be disrupted. What else?
I think you look at any commodity that's going to cross the border by truck specifically. I think we think of produce and a lot of other, retail goods that are going to cross that. And this is something that's going to be critically important, I think, to general trade as we're looking to expand that. I mean, it's also a little bit concerning given that in 2017, the U.S. president had designated the bridge a priority project in a joint statement, describing it as, and I quote, a vital economic link between our two countries. So obviously we agree, and modern border infrastructure is something that strengthens our shared economic security. And again, a lot of those commodities that are going to be crossing would be impacted, as well as the volume of trade that we were hoping to grow in a time that we're looking to grow both of our economies.
Do you see this as a shot at CUSMA or USMCA, perhaps something that could be put on the table as a disruptor for those negotiations?
I think we've seen the American president raise a number of irritants, whether that's border security or the digital services tax, over the course of this, as we've gotten closer and closer to the review of CUSMA in 2026, and so that's coming up. But look, Canada and the United States have been working closely together for decades. They're our largest trading partner and our closest ally. And what we do best together is build, create jobs, and these things will strengthen our collective competitiveness in the global economy. So with $3.6 billion in cross-border trade every day, there are a number of things that we're seeing raised as irritants and problems, but this is something that we definitely need to work. It's a relationship that is worth keeping and working on and improving, even as we look to diversify our trade partnerships and expand our trade capacity elsewhere.
Okay, so let me ask you about authority for the bridge itself and other crossings between Canada and the U.S. How typically does it work?
Well, when it comes to authorities on this bridge specifically, I think we've heard the Prime Minister say earlier today that this is something that Canada has paid for, and they'll be looking at tolls to recover the cost of building the bridge. But the ownership is going to be shared between the state of Michigan and the government of Canada. And so when these things come into play, this is something that benefits both of those economies. How this is going to be enforced and what the U.S. president has in mind when he talks about stopping the opening of this bridge, we'll have to wait and see. But we know that there are parties on both sides and businesses on both sides that are looking forward to the economic benefit that this new piece of infrastructure is going to provide. As
you know, the Prime Minister says he's spoken today to the president, explained to him what the situation is. How do you feel about that conversation? Is it enough, you think, to lay to rest any concern?
I think that the uncertainty that we've seen is certainly going to persist as long as we're seeing more threats and as long as there is concern around other elements of what the future of our trading relationship is going to be. That said, continuing to have that dialogue open and continuing to speak to our partners and working towards what the next piece of that relationship is going to be on working on negotiations and looking forward to the review and ensuring that businesses on both sides of the border are speaking to each other and to decision makers is going to be important in getting towards an agreement that we think is going to be fair. So again, if we're talking about doing things that are going to dismantle the effectiveness of trade enabling infrastructure, that's a very costly proposition and something that's surely going to lead to both parties together collectively relinquishing our economic position in the world. So we hope that cooler heads prevail.
All right, Pascal Chan with the Canadian Chamber of Commerce. Thanks very much for joining us. Appreciate your time.
Thanks for having me, Marilla.
Coming up next, we will have a look at the markets as investors prepare for a key U.S. jobs report due out tomorrow. Back in a moment. It looks like we will have another new record close for the TSX today. We will see if it holds until the end of the day. The markets in the U.S. are mixed, but let's go to Bruce Campbell, President Portfolio Manager, Stonecastle Investment Management, to talk about what's been going on. Thanks for joining us today.
Yeah, thanks for having me on.
So last week, things got pretty battered down. Software technology sort of dragged across all. What are you doing on the technology front? Have you moved to other parts of the build-out?
You know, we haven't. We still have a fairly good position in technology, certainly not in the software sector, but, you know, in a lot of the hardware areas and some of the other areas of the market that include technology. So we continue to see strong earnings growth there. And even in the software sector, I mean, you haven't really seen that much deterioration in the earnings yet, but the market is always forward-looking and is concerned about that.
Okay, did you hold software and get rid of it, or did you just not hold software?
Certainly, we haven't had any software in the last little while. Over the past history of the fund, we certainly have held software, but that's really based on a bottom-up process that we use to identify stocks that have the fastest earnings acceleration.
Okay, let's talk about the rotation, because we have seen it, and we talk about the small and the mid caps that are now benefiting from the rotation. Do you anticipate this trend to continue for the year?
You know, we really do. If you take a look at what we've seen from an earnings standpoint, that's really what's driving this rotation, in our opinion, as well as valuation. Because if you go back a couple of years ago, we really saw the acceleration in the earnings for the Mag 7, and you know they were increasing their revenue at close to 50%, and their earnings at around the same rate, and that rate of acceleration is decline now, so it's not negative, it's still positive by about 20%. But that compares to, you know, if you were to look at the Russell 2000 a year ago, that rate of acceleration was negative, and now it's turned positive. And typically when we see these trends happen, they're not just for a quarter or two, they tend to last, you know, multiple quarters in a row, you know, where you get out to probably like 18 or 24 months or longer. So it's not a surprise to us really that we started to see the smaller cap market start to broaden out and accelerate really in kind of the fourth quarter of last year. And it's really continued that trend through this year as well.
What do you think is drawing investors to smaller cap at this point?
Well, it's really that earnings acceleration, right? So as you see the earnings acceleration come in, and then the second thing is valuation, in that, you know, in some cases, not all, but in some cases, the valuation has been beaten up in the smaller areas because they really didn't recover to the same degree that we saw large caps recover out of the 2022 bottom.
Okay, let's get to sectors that you like right now. We touched a bit on technology and what you're doing there. What are the sectors you like overall?
Yeah, I mean, it's hard not to like the precious metals and materials sectors right now. I mean, based on what we've seen happen with the commodity prices, you're seeing amazing cash flow acceleration in all of those companies. So we have a fairly good weighting there. And then as well, we have you know, fairly decent exposure to industrials. We're starting to see that area of the market really accelerate. If you kind of go back into 2022, what we really saw was a manufacturing and industrials recession. The overall market didn't go into recession, but we certainly saw those areas go into recession. And now we're seeing that recovery, and we're seeing the stocks move up as we see stronger earnings across the board. And then the last sector that, you know, we have more interest in right now is the energy sector. And even though the price of the commodities have dropped down off their highs, we're seeing increased cash flow from a lot of the businesses because they've focused so much on their capital and their capital strategies. And as a result, they're really driving that cash flow going forward.
Okay, so let's talk about a few energy stocks you like right now. Bloom Energy is the first one. They are out of San Jose, California. What do you like about Bloom?
Yeah, I mean, they're not a energy company as you would think about as in oil and gas. What they do is they actually produce energy systems. So with all this, the hyperscalers and all the demand for electricity, they have a solution that allows for electricity to be generated on site, and it's modular, so they can add to those modules as more energy is needed. And the interesting thing is they use fuel cells, so it's not combustible, and so it's very green and very efficient. And if you look at what's happened with their earnings and revenue have just been ramping up over the last probably call it 6 or 8 quarters now, and they continue to have a huge backlog. They continue to have an increasing service business as well.
Okay, let's get to your second energy play, which is Tenaz Energy. Tell me about them.
Yeah, so Tenaz is an interesting company. They have some small amount of North American assets in Canada here, and then they have these international assets over in the Netherlands. And they bought those international assets from a large super major that really had that property on maintenance, and so it allowed them to go in, buy this for a pretty decent price for sure. But it's now allowing them to go in and do some drilling and to do some recovery work and some enhancement work on those properties, and they're getting increased production. And at the same time, the management team has told us that they're going to be doing more acquisitions like the ones they've done in the Netherlands. So we always have to watch for that, because they did that in an amazing way where they basically financed the acquisition mostly through the cash flow from the property.
Okay, I do want to get to your third pick here, which is TTM. They do circuit boards?
Yeah, that's right. They do printed circuit boards, and then they also do some radio frequency technology. This is used in, a lot of the areas that are really growing right now. So space, defense, autonomous vehicles. And if you, again, look at what's happened with them from a earnings standpoint, from a revenue standpoint, those numbers continue to ramp up in a significant way.
Okay, I'm looking at 605% over 3 years.
Yeah, I mean, it's had an amazing run, and it's now into that mid-cap space as far as the size goes, and I think there's probably potential for it to continue to grow here.
I was going to say it took off mid 2025, I guess, and that's then it shot up after that. But you think there's room to grow?
Yeah, I mean, one of the things that they have, kind of listed is that they want to be a leader, a world leader in this. And they continue to expand from a geographical region. They're in the U.S. and they continue to just grow and expand beyond that. So there's huge opportunity as they continue to grow their market in other areas geographically.
All right, Bruce, we will leave it there. Appreciate you joining us. Bruce Campbell is President Portfolio Manager, Stonecastle Investment Management. Coming up next, we'll hear from an aviation analyst on Air Canada suspending service to and from Cuba. More in a moment. Canadian Airlines are halting all travel to and from Cuba following a shortage of aviation fuel on the island. We were joined by Stephen Trent, independent aviation specialist, on this.
I do think in terms of the long-term story, this is going to be a mere hiccup. I think over the short term, certainly there's some dislocation here when we think about what it means for individual passengers and for rerouting opportunities, for example. But I don't see it. I see it far from being a major blow.
But it will be tricky. People who've already bought trips to Cuba, they'll have to work out how to handle them if there's refunds involved, et cetera.
Yeah, absolutely. So those folks, assuming they have refundable tickets, they'll need to be recourse to them. Maybe some of them will want to reroute. And that equipment that and crew that Air Canada had been planning to send to Cuba is probably now going to go to other places. So that's going to take a little bit of time to get through the system. And then we're talking about apparently roughly 3,000 Canadian nationals in Cuba that need to get home. Figure a narrow body aircraft to do those operations, and figure in 20 flights or so, and they can get that cleared out.
So they are introducing apparently a refund program, but I guess the details will emerge to a refund program for people who have booked, allowing customers who had scheduled departures to Cuba and experienced cancellations to get apparently automatically receive a full refund in their original form of payment. So they say there's no need for you to contact the Air Canada Vacations contact center. Yeah. my experience, good luck getting through to anyone over there. But anyway, and the other Canadian airlines, hardly surprisingly, following suit.
Yeah, absolutely. So, this is one of those things, clearly that's beyond any of these companies' control when you have these sort of force majeure events, or maybe that's too strong a word to use, but we saw it relatively recently further down in the Caribbean when Venezuelan airspace got closed for a little bit of time given the military action that occurred in that market. So there are hiccups along the way, but I would say certainly in Air Canada's case, this is relatively short-lived when we think about the long-term story. This is going to be a hiccup. Looking at the international strategy of the carrier, the fifth and sixth freedom rights they have through the region, international is a very good opportunity for the carrier. And Cuba is thankfully not that big a piece of the pie.
Can you remind us, do many Americans go to Cuba on holidays, or what is the situation there?
Yeah, sure. So you do have some of the U.S. airlines with flights there, Delta, American, some others. So it is a little bit more complex for U.S. citizens to travel there in terms of the paperwork needed and what have you. Certainly, Canadian and European nationals, it's an easier destination, and probably that's one of the reasons why you really haven't heard about significant dislocation at this juncture of U.S. tourists stuck down there. So Cuba's not a big piece of the pie at all for a U.S. tourist.
All right, that was Stephen Trent, independent aviation analyst. Let's have a look at the markets and where they stand ahead of the end of the trading day. Air Canada, as a result of suspending flights yesterday to Cuba, is down a little bit on the day. It's down just 0.25%, taking the stock price to $20.16. It's actually up 11% over the last year. Moving to Transat, another carrier that announced just today it will also suspend flights to Cuba. And remember, they're going to go pick up the travelers who have been left there, but no new flights to Cuba will go out. So that moved the stock down here about 9 cents to $2.55. But the stock is up 43% over the last year. Again, this is a stock that has been badly beaten down for many reasons. Let's take a look at the broader market. The TSX is set for another record close today. It is up about 0.75%, but 236 points, and it's over 33,260. So that will easily beat the last record at the end of January. Let's go south of the border for a quick look. The Dow was set for a new record as well. We'll see if it holds. It is at 51.58 or up. Not a material amount, 17 points, but it could take it above to a new record high. We'll bring you the closing numbers when we come back. Stay tuned for that. It is the end of the trading day. Here are the closing bells. At the Nasdaq, Olema Pharmaceuticals ringing the bell. In New York, Amphenol Corporation ringing the bell. And in Toronto, CI Global Asset Management. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. We do have a new record high for the TSX. 33,256 is where we landed today. That's up about 0.7%, so a 233-point gain for the TSX today. The S&P 500 dropped 23 points on a material change. The Nasdaq down 0.6%. That is a 136-point drop. Let's get to the movers in Toronto. The death of Vizsla miners in Mexico, they were kidnapped, is weighing on that stock today. It's rebounded a little bit, though. It's at $5.53 and actually moved up now 4 cents. It was down earlier in the day, but you can see a drop off there in the start of the month with the kidnapped workers in Mexico. Let's go to Energy Fuels. It is down today 6%, a $1.89 drop, taking the share price to $29.43. Celestica down today 6.7%. That's a drop of $28.80. And taking the stock price to $403.96. Shopify gaining today 7.7%. The stock's only up 8% over the last year, but it's at $127.58 today. And then Nova Gold Resources moving up as well, a 4.3% gain of 58 cents to $14.14. And ATS moving 4.5% about, a gain here, $1.82 to $42.42. Let's go to Bloomberg's equities reporter, Stephanie Hughes. She joins us now with details on the movers. Stephanie, let's start with Shopify. They got an upgrade today. Share the details.
Yeah, sure thing, Morella. So Shopify shares gained by over 8% at their highest point, which marked its biggest intraday advance since August. And that's because the e-commerce firm enjoyed a pair of analyst upgrades this week, leading up to its fourth quarter results, which are expected to come down tomorrow morning before the market opens. So the first one came after the bell last night by MoffettNathanson, who moved the company to a buy from a neutral rating. The team said that what's truly exciting about Shopify is the long-term opportunity presented to the company by the growing consumer adoption of conversational commerce. That's that thing where you go on a website, there's a little chat bot or some sort of AI interaction that helps you with your purchases. They also added that Shopify is far from being threatened by AI and, in fact, is a company that can greatly benefit from it. The other upgrade came from ATB Capital's Martin Toner, who moved the company to outperform rating from a sector perform rating, which is the equivalent of moving to a buy from a hold. Toner said that while the broader software as a service space is struggling with slowing growth, Shopify is actually in a pretty attractive territory as being a pretty capital light beneficiary of AI. More context on Shopify. They actually came out of the Black Friday holiday season pretty strongly with record sales, and a lot of analysts had good things to say about Shopify leading to the results tomorrow, expecting to see that really pan out there. So I will be here bright and early tomorrow to report on that and see what that looks like, Morella.
Okay, let's get to some stocks that are suffering today as a result of having to cancel the flights to Cuba. Tell us about Transat.
Yeah, Transat fell by nearly 4%, which was its biggest drop in just over 2 weeks. So not a mass, it hasn't been too long there, but it is because the tour operator is joining a growing list of airlines that are temporarily suspending their flights to Cuba because of fuel shortage concerns over at the island there. So from TD Cowen's point of view, this is a particular problem for Transat because of its exposure and reliance to Cuba as a destination. And in fact, Cuba accounts for as much as 15% of their winter travel capacity, according to their note. So that's why analyst Tim James downgraded the company to a hold from a buy rating, expecting that the suspension will cause an overhang on the stock over the short term. Now, the team does believe that there's going to be a buying opportunity once this situation is resolved, but until then, there might be a little bit more pressure on the stock just over the short term, Morella.
All right, we will leave it there. Bloomberg's Stephanie Hughes with the update in Toronto. Coming up next, a week of key economic data in the U.S. Retail numbers are already in. We'll look at that when we come back. Ford Motor Company reporting fourth quarter results. We're going to show them right now. Total revenue for the company coming in at $45.9 billion. That's actually down 4.8% year over year. Adjusted earnings per share coming in at 13 cents versus 39 cents year over year. And the estimate had been higher at 18 cents. So a miss on earnings per share for Ford. Here's the forecast for the year. They're seeing adjusted EBITDA at adjusted coming in at $8 billion to $10 billion, and the estimate had been at $8.86 billion, somewhere in between, which is the Bloomberg consensus. And capital expenditure, always a key one, of course, coming in at $9.5 billion to $10.5 billion, and the estimate had actually been lower at $8.88 billion. So we'll see how investors feel about that. tomorrow. The TSX hitting a record high today. We had some mixed markets for the U.S. Let's go to our next guest, who says diversification, of course, is key for 2026. Jack Manley, global market strategist at JP Morgan Asset Management, joining us now. Thanks for your time.
Of course. Thanks for having me.
Okay, let's talk about some of the air first coming back in software stocks. They were really depleted last week. Did you think last week's sell-off was overdone?
I do think it was probably at least a little bit overdone. You know, it feels like we're putting the cart in front of the horse when it comes to this AI transition. I mean, undoubtedly, artificial intelligence has the capability to, if not revolutionize, and certainly evolutionize. I don't know if that's a word, but to evolve the software capabilities of certain companies. But you are talking about a deeply entrenched industry with long-standing enterprise connections and decades, in some instances, of proven track records. That is not going to be abandoned overnight, especially when you consider that this new artificial intelligence linked program was developed in, I believe, under 2 weeks. It's not to say this thing doesn't have legs, that it doesn't have potential, but let's not get ahead of ourselves right now. Enterprise software is still a thing that's going to stick around for quite some time.
Okay, so it's not going to do the depth of the job you see some software doing right now?
Not right now, no.
Okay. What do you think about Google selling a 100-year bond? I'm still sort of wrapping my head around how it's going to work to pay for the AI build-out.
Well, I mean, that is a pretty remarkable headline. I guess it is a reflection of the fact that the balance sheets for a lot of these tech giants are just absolutely pristine. You know, when you consider that some of the biggest players in the tech space can actually borrow for less than the U.S. government, it starts to make sense why they are taking out these very long-dated debt instruments. AI is expensive. We are in the midst of what feels like a full-blown 21st century space race. And, we sort of opened up the floodgates, so to speak, last year with a little bit of leverage getting tossed into this mix. Some of those high-profile deals that were inked from some of those big hyperscalers. We are probably going to see more of this. And leverage typically is not always the best thing to see when you're looking at a market that could be considered frothy, that could be considered richly valued, that some might say is in a bubble. But when you're thinking about the leverage that's being taken out right now, again, by high-quality companies at very low rates, smoothed out over a long time, it might not be the canary in the coal mine that historically it had been.
I was going to say, investors have been a little more shy with some of the technology stocks. The shine has come off, if you will. They're off their highs. And I'm wondering if you think something like this makes them feel better about the stock or not so much.
It's hard to say. There's so many competing forces out there that are driving these AI stocks all over the place. I think it's actually helpful to maybe take a breath and zoom out a little bit, which is to say that artificial intelligence is very much here. It very much has the capability to fundamentally transform a lot of things in our lives, hopefully for the better, by the way, but just in general, a lot of things in our lives. It hasn't lived up to its potential as of right now, especially when you consider how much money is getting pumped into this space. But it will. The companies that are embarking on this extraordinary amount of capex, they have decades worth of a proven track record of innovation in a number of different industries that they either completely created or helped to revolutionize. I would not be surprised if AI is the same thing. So in a sense, don't worry too much about the headlines today or tomorrow, the choppiness that we've seen in markets over the past couple of weeks. If you are in this as a long-term investor for really anything more than the next 12 months, I think you're going to be just fine.
Okay, let's talk about global markets. Where do you see the strength coming from right now?
So I think from a global perspective, it is going to be, slow but steady economic growth. The global economy has been, I think, more durable than a lot of people anticipated, especially in the aftermath of the trade war that was kicked off last year. But at the end of the day, the U.S. equity market might have lagged most of its peers in 2025, but the U.S. economy did not. And after a relatively disappointing first quarter, it just roared back to life with 2 consecutive prints, pretty close to double the long-term average. I think that momentum is going to continue through the fourth quarter into at least the first half of this year. And so when I think about the macro outlook, I see the U.S. leading the pack, and I see AI-related capex and technology spend more broadly being probably the single most important driver of that underlying strength.
Okay, we had retail numbers out in the U.S., and they were pretty flat for the end of the year. Can you factor that in on what you see moving forward? Job numbers are expected as well, and there's weakness. We know there's weakness.
Undoubtedly, it's a tight labor market. It is not necessarily a strong labor market. We're calling it a low hire, low fire labor market. If you got a job, you're probably not losing it. If you don't have a job, it's going to be hard to get. As that translates into consumption, it all comes back to what we've long referred to, and I wish we coined this term, we didn't, but the K-shaped economy, right? This idea that if you got money right now in the United States, you probably never had more money than you do at the moment. If you don't have money right now, you're probably about as far behind as you've ever been in your lives. And the reality is that those upper income, higher wealth individuals do the overwhelming majority of the spend. A disproportionate amount of economic growth comes from those high income individuals. And while the labor market itself, to your point, may not be perfect, and the overall consumer, to your point, may not be perfect, the people that are actually moving the needle, they're benefiting from changes to the tax code. They're benefiting from high stock prices. They're benefiting from strong home equity, from relative insulation from higher interest rates. There's a lot going right with that particular subset of the American consumer that can help to propel consumption higher over the course of this year.
Jack Manley, good to have you, sir. Thanks for your time.
Thanks very much.
Coming up, as Trump's tariffs hit home, Canada's racing to strike new trade partnerships. We'll hear from Canada's trade minister about the negotiations when we come back. We have some new results from Lyft coming in to the newsroom. Let's take a look at what they are reporting for fourth quarter. Gross bookings coming in at $507 billion, plus, so 19% increase year over year, and the estimate had been just under that at $506 billion. Adjusted EBITDA coming in at $154.1 million, a 37% increase year over year, and the estimate had been much lower at $146.6 million, so a beat for them there. Revenue coming in at $1.559 billion. That's a 2.7% year-over-year increase. And the estimate had been $1.76 million, so they did miss on revenue. Active riders, 29.2 million. That's an 18% increase year-over-year. The estimate had been 29.21, so bang on there. Rides, 243.5 million, 11% bettering last year, and 255.87 was the estimate, so they did miss on rides. Here's the next quarter forecast, first quarter forecast for the company. They're seeing gross bookings at about $4.86 billion to $5 billion. The estimate had been on the higher end at $4.93 billion. That is coming from Bloomberg. And they see adjusted EBITDA at about $120 million to $140 million, and the estimate was $140.5. So they are missing in their estimate for EBITDA. Canada is pursuing free trade agreements with a number of countries as it shifts its focus in the wake of U.S. tariffs. Canada's Minister of International Trade, Maninder Sidhu, spoke to Bloomberg from Singapore.
Our focus and our goal of doubling non-U.S. exports to the tune of $300 billion. And what does that mean? It means more opportunities for Canada here in the Indo-Pacific, in Asia, but of course it means more opportunities in Europe for Canadian exporters. And so as we lead up to it, there's, if you look at how fast Asia is growing, they need more energy. With the data centers popping up everywhere, they're looking at Canada for that energy, but they're also looking at Canada for food security in terms of agriculture goods, but also critical minerals. As you know, Canada is resource rich in that. And so at a time when you're seeing a lot of ruptures in the global trading system, Canada is seen as a reliable, stable partner. And those are the phone calls that we're getting, is that we want to do more with Canada. And you've heard that from the Prime Minister's speech in Davos when we were there together, was about middle powers coming together and really respecting rules-based trade and pushing forward.
OK, loads to unpack here. You mentioned energy. What have you been hearing on your travels about appetite for Canadian exports like energy specifically?
Yeah, around LNG is what I'm hearing. Currently we've got 5 different projects in various phases of development. It was a milestone moment for Canada with our LNG Canada 1 project in June, our first ever large-scale LNG shipment going to Asia outside of the U.S. And so that speaks to our diversification efforts. How I'm going to get to a $300 billion target is obviously through energies. And so you're seeing that those projects are being built, they're being developed. But we're fast-tracking many of those projects through legislation that we've changed in June. Canada is now building at much faster, much quicker speeds than we've ever done in the past. And so as Asia builds, as they build data centers, as they grow year over year, you speak about India, 6, 7, 8% growth year over year. They need 70% more energy by 2040. Guess what? Canada is well positioned to serve those markets.
And give us a sense, Minister, of how much Singaporean appetite you've seen to invest in Canadian ports, for example. Have you had any meetings around that?
Yeah, absolutely. I mean, when you come back to our strategy and our take on hitting the $300 billion of exports, additional exports, we're going to need to add capacity at our ports. And so we're doing that. We've got a $5 billion trade corridor fund as a federal government, but we're also working with partners. I've met with PSA, we've met with GIC, Temasek. They are all comfortable investing in Canadian ports, in Canadian infrastructure projects, and there's conversations to do even more in Canada. And just in the Gulf region, I was there a few weeks ago. They've committed to doing about $70 billion of investments in Canada, in infrastructure, in mining, in energy projects. And so we're building up capacity, and we're welcoming investments from all around the world.
And what's the latest on the Canada-ASEAN FTA that Prime Minister Mark Carney pledged to finalise this year?
Yeah, Philippines is now the chair of the ASEAN, and we're continuing to have conversations with the Philippines to get it through. Of course, there's many partners, as you know, over 10 partners in the ASEAN region that we need to continue to engage with, continue to explore opportunities. But we're having active negotiations. Our negotiators are in Jakarta this week having their round of negotiations, and we'll continue pushing forward. The Philippines has made Canada one of their priorities as the chair, and so we'll continue engaging with that. But this year alone, since you asked about FTAs, free trade agreements, we've got a handful that we're moving forward on with India, Philippines, Thailand, UAE, Saudi Arabia, ASEAN, Mercosur. And so you see there's a lot of work ahead of us, but I think the appetite is there from many of our partners around the world to make sure that trade works. Just in the past 9 months alone, we were moving really fast at record speeds. We typically sign one agreement a year. In 9 months, we've done multiple agreements with the UAE, with Indonesia, with Ecuador, and many others. And so there's an appetite there to do more with Canada. As I said to you before, it's about reliable, rules-based trade, and Canada stands for that.
You're a busy man, Minister. Which of those deals is closest to the finish line?
So we just completed Indonesia, Ecuador, and the UAE. We're starting with India in the coming weeks. Philippines as well. It was something that we signaled when we were in Malaysia not too long ago. But of course, we're going to continue moving forward. Mercosur is another one of those important trading partners. But again, when you're dealing with multiple countries, you need to make sure you match their speed and energy. And we're going to continue to have those conversations to push forward.
And Canada signed this deal with China to cut tariffs and attract Chinese auto investment. Of course, that drew the ire of President Trump. Coming back to my original question, Minister, how is Canada balancing the upcoming USMCA talks with your push to grow non-US exports?
Yeah, when it comes to the U.S., look, they're our number one trading partner, will always be an important trading partner to Canada. And those discussions will continue. There's another minister, Minister LeBlanc, that's in charge of Canada-U.S. relations. My focus is on international trade diversification. And so I was with Prime Minister Carney in China a few weeks ago. It was to make sure that we're exploring opportunities, but also to work through some tariff challenges that we were having in the agriculture sector. And we were happy to come with an arrangement to give our roughly $7 billion of agriculture products preferential access to the Chinese market. So resolving that was very important, but also unlocking opportunities around electric vehicles. And so we're going to be allowing up to 49,000 vehicles into the Canadian market with the hope of joint venture partnerships, between Chinese and Canadian companies to build those EVs in Canada. We're a large market. Canadians consume or they purchase about 1.5 million vehicles every single year. They're asking for more options, but it's not just with the Chinese. We had the South Koreans there last week. I hosted Hyundai. They're looking at opportunities in Canada. And just earlier today, we had the German Minister of Economy visit Canada to talk about some type of economic cooperation between Canada and Germany, but also to explore cooperation around automobile manufacturing. And so this is a conversation that's happening with many countries. And why is that? I think it's important to mention is on the mining resources, we are heavy resources in terms of what we have. We're the only country in the Western Hemisphere that have every single element to make an electric battery. And so I think it's important we have those conversations. And this is why automakers are looking towards Canada, and we welcome that.
Coming up, Alphabet issuing a 100-year bond, demand through the roof. Back in a moment. Some more results coming into the newsroom, this time from Robinhood. Fourth quarter results for the financial services company. Net revenue coming in at $1.28 billion. The estimate had been $1.35 billion from Bloomberg, so a miss on net revenue for this company. Adjusted EBITDA coming in at $761 million. The estimate had been higher than that, $833.2 million, so a bigger miss for the company there. Earnings per share coming in at 66 cents. Now, net deposits for Robinhood coming in at 15.9, so just shy of 16 billion. But the estimate had been 19.44, so another miss for the company. And then average revenue per user, 191. The estimate had been above that as well at $200.85. Here's the year forecast. They're seeing adjusted operating expenses and share-based compensation coming in at 2.6 to 2.73 billion. All right, let's get to this. Also today, Alphabet issuing 100-year bonds, and demand was higher than expected. Let's get more from Dan Ives. He's global head of tech research at Wedbush. Dan, what other companies have ever done this, sell a 100-year bond?
Yeah, I mean, Motorola, back 1997, that's the last time we saw it. And look, this is highly unusual. It speaks to the demand, but no doubt, I mean, the 100-year bond definitely was a bit of a head scratcher, I think, to everyone.
Okay, so what is the benefit of selling a bond with this kind of term?
Look, I mean, durability. I mean, obviously, a lot of institutions, the rate in terms of the ability to get this bond are all attractive. But a 100-year bond, I mean, look, this is probably not the last we've seen of it. Just given the demand that they saw, which is pretty strong. We'll probably see more of it, actually, over the coming months. How risky is it for investors? Look, I think given the durability of Alphabet, it's almost like a small country. So obviously, it's as durable of an asset as you get from a tech perspective. And that's why, look, not any company could do this. The fact that they did this, you could probably count on two hands the amount of companies that could do something like this. Do they need to do it to fund their AI ambitions? Yeah, I mean, look, it's an arms race. So they need to continue to invest. We're talking about ultimately hundreds of billions, right? I mean, over the course of years. But it's not just them. I mean, look at Amazon, look at Microsoft, look at everyone. We're talking almost $700 billion that's going to be spent in CapEx this year. That speaks to why they need to do things like this. And how are they doing on their plan to build out? I mean, they've been very successful. Look, a year ago, they couldn't do this. A year ago, the Toronto cab driver was bearish on Google. But now, look at it today. I mean, they've had a lot of strength. You look at Gemini, you look at ultimately what they're doing on cloud. They've been very successful, which is why they're able to do that right now. Would you say Gemini then is well ahead of some of its peers? Well, I think Gemini has closed the gap very significantly versus OpenAI. It's actually put more and more pressure on Altman and OpenAI. And I think that's why they're continuing to invest, because they know this is an opportunity. Right now, it's go time for them. They're on the aggressive move, and that's why they did this bond offering. But it speaks to a much more aggressive company right now relative to seeing success in the AI revolution.
Okay, so with Gemini, what do they need to do to ensure growth there? Because as we spoke about, there are many competitors.
Yeah, I mean, look, OpenAI, I mean, you're talking about the goal to get to 1 billion users. It's not just about Gemini, it's also about enterprises. Enterprises, they're going to the cloud. They need to do with Google, just like Microsoft, just like Amazon. That's really right now what they're playing. That's what they're going for. It's a smart strategic move. The 100-year bond, it's a little odd, but it does show, I think to some extent, the confidence investors have in them.
Okay, so talk to me about who else you could see this from. You said it is very unusual, it's a rare thing, but at the same time, you could see others going the same route.
Yeah, I mean, look, given the success they've had, other tech companies could follow. You're going to see more and more bond issues to fund the AI revolution in big tech. And that's something we're going to see more and more, especially over the course of 2026.
So when you see Mag 7 stocks off the way they have been, right, the shine has been off for investors since, the middle of last year. They haven't come back, many of them, the way that they were. What do you think?
Look, I view it as it's really more second, third, fourth derivative beneficiaries that are playing out. Palantir, others, Nebius, across the tech landscape. I do think this is just a near-term period. Big tech, Mag 7, are key ingredients in the recipe for success for AI revolution. But I think now the themes spread, and that's why you may be seeing a little bloom come off the rose. But I view it as more, that's an opportunity. This is not the end, it's just the beginning.
All right, Dan Ives, I'll leave it there. So thanks for your time. I appreciate it.
Thank you.
Coming up next, Canada Mortgage and Housing Corporation released its forecast for the year. We'll share that when we come back. Time for some hot picks. We zeroed in on 3 plays in biotech with Jeff Meacham, Global Head of Healthcare at Citi. We kick things off with his first pick, which is Eli Lilly.
I do feel like with Lilly's injectable business, Zepbound and Mounjaro are both growing nicely. But also, orforglipron is really one of the reasons why you want to own this stock is their pill, which is going to launch, in a maybe an April timeframe. I think it's going to really dominate.
And that, of course, is a pill weight loss drug.
That's correct. Yeah.
They have other irons in the fire, though. They have a medicine in inflammation as well. Can you tell us a bit about that?
Yeah, so what's interesting is that the GLP-1 mechanism of action is broadly applicable. And what Lilly's finding is that it could help amplify the clinical effect in other diseases. So they just recently had data, for an inflammation drug, Taltz, that the GLP-1 makes it better. So I think that could, provide an extra leg of fuel for their inflammation business, maybe down the road, oncology or neurology, GLP-1s work, in a broad way. And I think that that's something that obviously not in the stock at all.
Can we move on to Vertex Pharmaceuticals? One of their core businesses, cystic fibrosis.
Yeah, this is a great business for them. There are very few competitors here. Vertex has really dominated and probably should continue to dominate, really. And the IP goes really quite far out. We're talking late 2030s. The issue with Vertex is really, what is the encore to their success, right? So they have a drug for non-opioid pain relief, and they have a cell therapy, a gene-edited product for sickle cell anemia and beta thalassemia. And now they're adding a drug. We'll see maybe this Thursday when they report, fourth quarter earnings. There's a drug for a kidney disease called IgAN. So a fourth, drug to the mix here. So that's probably the bigger focus of Vertex. The CF business, I wouldn't ever say autopilot, but it definitely feels like, it's sort of it's going on autopilot.
And then Regeneron Pharmaceuticals, you see this stock climbing to the $900 range. What are their crucial growth areas?
Yeah, so Regeneron has had for many years, 3 legacy businesses. So Eylea for an ophthalmology drug, Dupixent, which is a drug for many different types of inflammation conditions, and then Libtayo, which is an oncology drug. Those are still, growing nicely. Eylea has had some generic competition and had some branded competition, but that's fine. It's held its own. But the reason why we like the stock here is the pipeline. So they have a next-gen drug for melanoma that could be, any time in the next couple of months. And then a very, very deep pipeline in the oncology hematology franchise that, in the next, call it 1 to 2 years, we'll see a lot of data points, a lot of phase 3 reveals, phase 2 reveals that should be very positive for the stock.
What is the latest thing in oncology? Can you generalize for us? What are promising areas of research right now and new drug development?
Yep. Yeah. There are a couple different technologies that have been used. Antibody drug conjugates. This is where you attach a toxic payload, a bit of a silver bullet approach to a tumor. And then immuno-oncology, same thing. It's tools that have been around for a few years, but we're getting much better at engineering more specific immune responses to the tune of what called bispecific antibodies. So there's a lot of excitement there, and there's a lot of companies in the mix too. So it's not just about gene and cell therapy. There are many, very, I would say, validated and foundational technologies that are still growing quite nicely.
And a company like Regeneron, what's a crucial driver? I mean, they obviously want to get a blockbuster. Everybody does. Would they ultimately get taken out if their product is big enough?
It's a great question. Yeah, it's one of the bigger, larger cap biotechs by market cap. But they have a very deep science, a great, technology platform, and they're in multiple areas. So I think the big driver here would just be, turning the data card over on many different things in the oncology hematology pipeline, but also the inflammation pipeline. Those are the 2 core areas for them. It's not that, that they need more, but I think they have so many assets that are in early to mid development that are really kind of, could be groundbreaking. We'll have to see.
Jeff Meacham, Global Head of Healthcare at Citi. We have a forecast for housing from the Canada Mortgage and Housing Corporation. They say the sector faces headwinds that will keep growth slow. Let's go to Kevin Hughes, Deputy Chief Economist at Canada Mortgage and Housing Corporation. Thanks for joining us today.
Thank you for having us.
What are the biggest challenges you would say affecting home building across the country?
Well, the challenges come from several areas. I think first and foremost, we have to speak about the quite high and unprecedented degree of uncertainty that we see in the economy, which is also apparent in housing markets for businesses, for developers, but also for our consumers, for households, and for those thinking of forming new households. That definitely has an impact. We can add to that lower population growth as well, as we know housing is very dependent on that. And as well, income growth that is, let's say, modest recently, and carrying cost as well. So several headwinds. So we do expect, especially for construction starts in particular, that we are looking at slower pace for the next few years.
Okay, when you look just at the demand side, do you expect that then, for all the reasons you said, to stay low? And is that for rentals versus owners?
So that's in general. So if we go by market segment, obviously, and of course we're talking about the country as a whole when we look at different sectors of the country, Ontario, for example, as opposed to Calgary, for example, or Montreal, there are differences there. But generally speaking, we have challenges on the demand side, job security being one, carrying costs I mentioned. Prices are still relatively unaffordable, despite more supply. The rental market has been an area where we've seen more construction, and we've seen as well, according to our rental market survey, an easing of those markets. So, for example, currently Toronto, we're expecting around 3.5% vacancy rate, which will probably be the same next year as well. So some respite there for renters, but still we're talking about marginal gains.
Okay, let's talk a little bit more about the regional differences, because Toronto, you do see more rental starts. Why is that?
Well, it's been a segment that has been definitely outperforming the condo segment, for which is oversupplied currently. And so, multi-unit development in Canada is definitely, the main source of constructions. Roughly 80% of starts are in multi-unit, especially apartments. So for several years now, that construction has been motivated by relatively sustained migration. We know that we have lower levels right now, and also probably less household formation of young households as well. So that's taken some pressure off of demand, and so even though the rental segment has outperformed, we do see that also slowing down.
Okay, let's get to BC, of course, with its key Vancouver market. What do you see happening there?
So we see Vancouver's resale market going kind of back into balanced conditions. So not more favoring suppliers that are like demand or supply. Stable prices, starts will go down, and the vacancy rate is let's say notably higher than in Toronto. We're looking at around 4% vacancy rate for the next 2.5 to 3 years. Calgary is going back from quite a strong market, bit of moderation, less migration there as well. Sales will also be stable there. And here we see the impacts of quite strong rental construction because the vacancy rate is around 6% in Calgary.
Okay, let's get to a region that you see perhaps building above the average. Where are we looking?
Well, when we compare let's say those four major markets, Toronto and Vancouver, certainly those that will be slowing down the most, and those who will be more resilient, we're looking more at Calgary and Montreal. However, even Montreal, we're looking at slower population inflows for migration, rental market that is still easing as well, and so demand will be going down there. But here we're looking at a bit more resilient market. We have to consider too that when we're talking about construction in Toronto, we have quite a lot of very high rises compared to Montreal. That adjustment is much slower, and so that just the composition of the market has an impact on how fast it adjusts.
And Montreal has been on a real build out of rentals.
Well, Montreal is the largest rental market in Canada, and rental demand has always been a feature, and it's still, you could say that for the rest of the country, but definitely it has been strong. As we say, it will be also coming off a bit of pace this year, which is what we observe elsewhere. One thing to note, I think, when we look at the economy and how that impacts the housing market, is that right now, I mentioned, we all see this and observe this not only in the numbers, but in when we talk to the industry and look at our survey results, there is that uncertainty. But at the same time, the potential there is present, potential for economic growth and potential for people re-entering the market. Right now, the uncertainty is such that many actors are just holding off on those decisions. Should the environment improve even this year, that could have definitely some impacts in the outlook that we're, and adjustments that would be needed from the outlook that we're publishing today. So we are, in the last 2 years, we've been publishing a mid-year review adjustments, and so we'll be doing that again this year. So a lot of eyes on the macro economy for obvious reasons, and how that exactly will be influencing businesses, but also households and consumers. Governments remain really the source of growth this year, so we're forecasting just under 1% GDP growth, and that will be largely due to the major government infrastructure investments that have been announced.
The build-outs. All right, Kevin Hughes, sir, thanks for joining us. I very much appreciate your time.
Thank you.
Coming up, shares of Organigram down after the company missed on revenue. We'll talk to the new CEO when we come back. Shares of Organogram trading lower today after the cannabis company posted lower than expected net revenue. Joining us to talk about this is the new CEO, James Yamanaka. Thanks for joining us today.
Thank you.
Okay, so let's talk about net revenue coming in $10 million lower than anticipated. I know you've just started the job, 3 weeks literally on the job, but what's your storyline around why it came in that way?
First of all, I think in bigger picture context, on a year-on-year basis, net revenues were up by about 49%. Adjusted EBITDA is up about 5.3%. And even with those results, recent results, we continue to hold our guidance for the year. In terms of the miss in the first quarter this year, it was largely due to a number of temporary issues. Number one was a softer overall market. Two, there was a strike in BC, which meant we were out of stock for about 8 weeks. And three, there were some spec issues with some of our international exports. All of these things are temporary and things that in British Columbia, for example, it's already back to normal, and the rest are temporary, so we're still confident in the full year guidance.
When you say lower demand, was that sort of internationally? Because I know you work in Germany, you distribute in certain spots, or working with the U.S. and Australia.
No, this is Canada, essentially flat year on year, so a little softer as an overall market than was expected. The markets in Germany continue to grow.
Okay. You had an acquiry of Motif. I'm wondering how that's working. Are there synergies from that yet?
Yeah, I think at this point we're fundamentally done with the Motif acquisition. I came in, as I said, 3.5 weeks ago. It is one company, so the integration period is completed. And I think we've generated now the $50 million of synergies that we announced last year.
Okay, let's talk a little bit more about some of the markets you are looking at and maybe looking to expand. You mentioned Germany is still strong. What do you think is feeding that demand there? How are you doing in Australia?
I think in all these markets, I think the thing that drives it is a regulatory system where people can operate. So in Germany, you have a system that works. It's been growing exponentially over the last few years, and we expect that to continue. There's a few markets in other markets in Europe that there are open to medical cannabis. And the U.S., with the recent announcements, I think it's a bit uncertain from a organogram point of view, because although we're in the market, it remains a relatively small part of our business with under 1% of our revenues, because we've been quite prudent to make sure that we are measured in how we invest in the U.S.
Are you going to gear up if things change in the U.S. and you have greater access to the market?
I think a lot has to happen from a regulatory point of view to make it possible or advisable for Organogram to move into that market. We've taken, as I said, a measured approach, and I think we'll continue to make sure we don't underinvest but don't overinvest. And I think in the short term, the priority is probably more to allocate the capital to the Canadian market as well as the growth in Europe.
Okay, so where do you see growth coming from this year and next?
I think this year it'll be, our performance in Canada remains strong. We're still the market leader in Canada. I think there's improvements we can do. We've held our gross margin flat despite sort of the softer Q1, and I think that's a good indicator of our ability to drive greater margin over that time. And I think over the next couple of years, I think a large proportion of the growth will come from international sales, particularly Germany, but other markets as well. We also export to the UK, to Australia, and to a few other markets in Europe as well.
What are the products you do well with?
I think generally, Organogram, we're the market leader across the board. I think we have a very strong position in gummies. We're just launching some drinks products. We're making good progress there. I was in Winnipeg last week and I saw the new beverage line coming. And in the next couple of months, there's a couple of launches I'm quite excited about with multi-packs of beverages, but also shots where we have a claim that we can justify of 15 minutes on set, which is a differentiator in the market. So I think there's general overall strength, but some exciting new things to come.
What's the competition like in the space these days?
It's very, very competitive. I think compared to where I come from, it is even more competitive. That there's a lot of players remaining in the market. I think, given that, you have to be on top of your game, on top of your pricing, execute extremely well. And from our point of view, we really need to focus on reducing the COGS, doing things like improving our yields by about 50%, which we did this year, to be able to make sure we can compete effectively in the market.
And pricing, I guess, is key.
Look, you take pricing when you can take it. I don't think the model depends on it. But we have strong brands. We have 3 of the top 10 brands in Canada. And I think we can leverage that for some pricing. But fundamentally, we also just need to improve the gross margin from a little on the top line, but also to make sure we really drive some of the savings and productivity gains on the bottom, on the cost side.
Okay. We do have to leave it there. James Yamanaka, CEO of Organigram, thanks very much for coming in.
Thank you.
I know your options is coming back. That's tomorrow, 3 p.m. Eastern Time. Have all of your options trading questions answered by Chris Tom of Moat Financial. That is tomorrow. And thanks for joining us today on The Close. We'll see you back here tomorrow.